Sudip Bandyopadhyay on the show with us. Sudip, hi, afternoon. Good to have you on the show as always. Sudip, key numbers, nothing on the index, but I guess the action is pretty much outside the index. Some really good reactions coming in on Atitagarh wagons, which is sitting at a life high. We were just marking the reaction coming in on Mastec as well, and Taracom too, after the management commentary, even though the numbers were a little, muted, the stock has now jumped up about 4%.
Yeah, absolutely right. Market is generally flat, and I think we have to stop looking at the index. A lot of action, a lot of excitement is in the mid-cap universe. There are multiple reasons for that. The way I look at it, one, I think mid-cap was a neglected space. Probably the multiples at which most mid-cap companies were quoting were below what they deserve. And look at what has happened now. The rail-related excitement is definitely there with what is happening with Vande Bharat, the kind of orders which are coming. So we know where Titagarh wagon is. We know there is excitement in Concor. Also look at the Indian domestic pharma pocket. I think that's doing well. A lot of mid-cap companies there. Look at some of the defense names. There is excitement, and they are in the mid-cap space. Look at a lot of these. Look at auto ancillary. Why leave that out? I think there are challenges and positives and negatives in auto companies which are in the large cap space. But auto ancillaries by and large are doing very well, and they are pretty much all of them on the mid-cap space. So yes, there is excitement, and they do deserve attention, and that's pretty much what we are getting to see. Of course, because mid-cap index comprises of many companies, and there are positives as well as negatives, so the index is not doing anything. But individual pockets in the mid-cap universe are definitely exciting and deserves attention.
Talking about the mid-cap space, I wanted to bring your attention to the footwear companies today, Sudip. So whether it's a Mirza International, which has seen a solid run over the last 2-3 sessions, you have a Metro brand, which is up 6.5%. The likes of, other footwear companies like Bharat Sector are also gaining traction. You have Relaxo, Campus Activewear. All of these stocks are seeing a material move today. Would you be a buyer in any of these footwear companies or any other urban consumption theme?
Well, I think, if you look at the footwear companies, they were beaten down mercilessly as well. Think of Campus, where it, got listed and where it has been beaten down too. So it was looking a little oversold, and some amount of buying was expected. But having said that, if I have to honestly give an opinion, I don't think, I will touch these companies at elevated valuation even today. And probably I will, if I have to pick up a footwear company, I'll go back to the tried and tested Bata. I think this has got some more steam, and for a slightly long-term investor, Bata looks good even now at current valuation. As far as the consumption space is concerned, I think if I'm an aggressive investor, I will still bet on HUL and Dabur. I think both these companies have significant rural consumption. HUL about, out of the sales, about 30% plus is from rural. Dabur is about 50%. The rural consumption, there were some challenges. So obviously, the prices were not really moving anywhere. But having said that, if we have no El Nino and a decent monsoon, we will see these stocks flying. So I will, for an aggressive investor, I will bet on HUL and Dabur.
Okay, so that's about HUL and Dabur and how you're playing the consumption theme as well. Any hotel stocks that you want to call out, Sudip?
Well, I think definitely there is an exciting space, and these things, all the hotel companies have moved up quite a bit. We know what is happening with occupancies. We know what's happening with the, the conventions, the marriages. So it's a really great season. Probably a kind of environment which hotels haven't seen in last 10 years. So it's great time for hotel companies. But looking at the valuations, I think I'll be a little careful. One company I can look at probably still is Chalet Hotel. They're doing a lot of exciting work. They have recently acquired some properties outskirts of Bombay, Lonavala, pretty well-known properties, and those are also coming under their brand. They work with marquee brands, Marriott's of the world and all. So overall, maybe chalet hotels at current level for a long-term investor, but Indian hotels and other frontline hotel companies at this stage, I'll be still cautious.
Okay, that's definitely not Indian hotels. Chalet is the one that Sudeep was recommending a buy on, and his previous stock pick was Bata that he likes. So that's Chalet Hotels, a little bit tempered in trade right now. 368 is where the stock is. Bata, of course, is seeing bigger gains, 1.6% higher on Bata as we speak right now. Kunal, but within the hotel space, you've restricted your themes to only IHCL as well as which one? Lemon tree, right? Yeah.
So yeah, there are very few players as it is, and even when we look at the mid-cap end, so like the likes of Oriental Hotels, Taj, GVK, etc., they are very high beta stocks in the entire hotel pack. So you always want to prefer that we are venturing into a smaller sector relatively. That you would probably want to go with the sturdy names. So I think in that regards, Indian hotels looks very attractive. I think just close to that 300 levels, almost a month and a half out back when the stock had corrected. That's the point where we initiated a buy. We still maintain that bullish stance on the stock, even at current levels of 335, 340 odd levels. And my expectation is that possibly in the near to medium term, we could be looking at 360 as a potential target. So Indian hotels is something which I would prefer specifically from the entire pack.
Sudeep, did you manage to look at the numbers from Mastech? Does it deserve that kind of up move that we are seeing today? And any expectations as far as HCL Tech is concerned?
Two things. I think let's look at the Mastech numbers first. The way I look at the entire IT pack is we have to be very company specific. Now, particularly in case of mid-cap and small-cap IT companies, on the back of the fact that they have a set of clients. Now, if some of their clients have got into challenges in US or in other global markets, obviously they may get impacted because of postponed orders or cancelled orders. Now, in case of Mastech, that didn't happen and hasn't happened, and some of them are delivering critical work for their the outsourcing partners, and they will remain critical. So under the circumstances, to paint the entire sector with the same brush that everybody will have order cancellations, everybody will have postponements and all that may not be right. And that's the lesson which I think should take from Mastech results. I think results are pretty good, and they definitely deserve a thumbs up, and that's what market is giving them. Whether the valuation after today's up move is whether it's fully valued or not, I think is debatable, but I think they deserved an upward movement in prices, and that's what they're getting. As far as HCL Tech is concerned, I think we have been pretty positive on HCL Tech for a very, very long time. Unfortunately, it has disappointed us time and again with quarterly numbers below expectations consecutively for the last 3-4 quarters. So we are going with muted expectations. Let us see. One has to remember that this HCL Tech was a differentiated IT company amongst the top 4. TCS, Infosys, and Wipro are pretty much same, or I would say similar in terms of the service offerings, in terms of what they're trying to do. Whereas HCL Tech always was differentiating themselves through product and services, and also engineering services. They also went ahead and acquired a lot of businesses and companies in Europe and built a strong European pipeline. So it is a different company. Let us see what they come up with. We of course will focus on their commentary, management commentary, and what they talk about the margin guidance and the future quarters. We'll of course have to see what is their order book position, whether there are cancellation or postponements. All that we will see, but we are going ahead with a muted expectations.
Okay, that's an interesting take coming in on the IT pack, and of course HCL Technologies is what we're going to hear from today evening, say around 5ish is when we can expect the numbers. But Kunal, what about your closing ideas?
So Motherson Sumi is a stock which is, in fact, Samvardhana Motherson, that's a stock which looks extremely attractive. 69.5 is where the stock is trading right now, and that will be the closing trade.
Right. Naresh, what about your closing ideas?
Limited, the stock has continued to be in a strong uptrend and is now setting up for a fresh breakout into 52-week highs above the 82 mark. So it's interesting for a move towards 90 in the near term.
That note, we'll slip into a very short break. Don't go anywhere. It's last 30 minutes of the trading session and weekly options expiry. So we'll track that when we come back.
Back with closing trades right here on 80 now, and still nothing has changed actually from the last 3 minutes to now. We're absolutely flat still on the index, but it's the breadth which is looking lively. Having said that, if you were to just take an individual count of the advanced declines, there's not a difference. It's pretty much neck and neck. But yes, the gains are more as compared to the quantum of the losses that the laggards are seeing. So yeah, sure enough, you do have a TVS Motors and a Divi's which are down 3.5 to 4 odd %. But on the gaining side, there are bigger movers. Trent is up 2.5%. CUB is up 3.5%. Page Industries is up 3.5%. Cummins is up 3.6%. And Tata Com continues to sit right on top there with a near 4% move. Tata Motors, of course, is the other one, which is also seeing some solid gains coming in. Mahantesh Sabirad as well joins in on the show right now. Mahantesh, hi, afternoon. Just wanted your take on Tata Motors, especially in light of the JLR capex that they've announced.
Good afternoon. That JLR capex is a welcome move, but the quantum is pretty large. In the past, Tata Motors has been consuming a lot of capex in terms of supporting its JLR arms, and particularly this capex is quite heavy. Well, the announcement of a capex generally means that the company is headed for better forecasts ahead. I'm just too worried about whether that capex will be sustained by the current set of cash flows. Already the debt levels are something which are a cause of worry for JLR.
That's the word coming in as far as Tata Motors is concerned. But of course, the other big boy to watch out for is Reliance. The earnings will be out tomorrow. Let's try and understand the expectations with Somit.
Well, on a consolidated basis, if you see, not a big bang set of numbers are expected from Reliance Industries. The revenues are expected to be high by only 2%. EBITDA could increase by around 4.5%. Margins are expected to come in at 16.6%, while the net profit is expected to be 6% higher on a sequential basis. Now, if you see segment-wise performance, it is the O2C segment that is expected to lead the growth for Reliance Industries in the fourth quarter, and that is the reason why. And this is because the EBITDA growth of O2C segment will be the highest compared to other segments at around 9 odd %. Now, O2C segment benefited because of a steady refining margin and because of higher petrochemical margins in the fourth quarter. Now, petrochemical margins were also higher because of lower energy costs that we had seen in the previous quarter. Moving on to the gas exploration business, now that is expected to see a 4% increase in its EBITDA, and this will be largely on the back of higher volumes because gas prices remained largely stable on a sequential basis. When it comes to the retail segment, that segment's revenue is expected to rise by around 3 odd %, while the EBITDA growth is expected to be around 4%, and this will be purely on the back of store expansion and operating leverage for Reliance Industries.
So that's the expectations from Reliance, but Jio, of course, forms an important part of the business as well. Somit, what's the expectation? Pretty much flat, right?
Well, from Reliance Jio, which is the telecom arm of Reliance Industries, yes, not much growth expected on that front. Also, even in fact, if you see the EBITDA and the net profit growth for Reliance Jio is expected to be around 2 odd % and 0.6%, and this will be the slowest ever growth reported by Reliance Jio in the fourth quarter of FY23. ARPU, which is the number for the telecom company, is expected to come in pretty much flat at close to 179 rupees per user per month, while the subscriber base is expected to be slightly higher at close to 43.9 crore user base. Now, whatever growth we are seeing in the Reliance Jio number is purely in the back of subscriber addition, as there was no tariff hike and cost was also higher on a sequential basis because of 5G launch. We are seeing such a slower growth on the EBITDA and on the net profit front. Now, apart from the results, what are the key things to watch out for from Reliance Industries earnings? Firstly is the net debt number. Earlier the company Reliance Industries was a net debt free company, but now its net debt has increased to around 1 lakh crore. So where this number is going to be at the end of financial year 23 would be important to watch out for. Along with this, how has been the performance of its recent investment in retail and a new energy vertical would also be important to track. What is the update on the demerger of Jio Financial Services, something that investors would be keenly watching out for, and what has been the 5G traction, what are the 5G monetization plans going ahead would also be important to track from Reliance Industries and Reliance Jio earnings.
Okay, so that's the take coming in as far as Reliance is concerned. But just let's quickly take stock of what's happening, because we are not seeing that expiry move come into the markets at this point of time. Let's look at the global markets as well as to what they are doing. Europe has started on the back foot, Aisha. You have a cut of almost 0.6%. And even if you look at the pre-market rates from the Dow as well as NASDAQ, they are suggesting cut of 147 points. And look at NASDAQ, a cut of almost 1%.
Yeah, but a FTSE, a CAC, they're all sitting at 52-week highs as well. So it's actually, a meaningless fall, not even a fall actually, barely even a dip that you're currently seeing. So that doesn't really matter. Having said that, Sudip, do you think at least in the near term, this entire correlation of our markets with what the globe is doing has gotten disconnected?
Well, I won't say disconnected, Aisha. I will say that we are more focused on our, corporate earnings because there are no major global events or even domestic macro events. So I think the entire focus of the market is on corporate results. Like today we are talking about HCL, tomorrow we'll talk about Reliance, and I think a whole lot of other smaller company results. And I think that's pretty much what's going to happen. Also, we will be more and more focused on the monsoon and the progress of monsoon, distribution of monsoon, El Nino or otherwise. So yes, the dominance of domestic news flow will be there for some time. Unless there is a major global event which makes us or forces us to take note of that.
Okay, so that's a take coming in as far as whether the correlation will continue or not. But these are the questions we posed to Atul Suri also earlier in the day to try and understand where does his preference lie. Let's listen into his rationale coming in on the sectors and stocks he likes at this point of time.
That sectors or themes, because we look at themes and we think 70% of your work is to get the theme right.
Yeah, true.
Right? So we find that electrical equipments,
Okay.
engineering,
Okay.
these are sectors which have been decadal underperformers.
How much weightage do you think one should have? For example, if we use Nifty as a benchmark, 35% is financial. So you need to stand somewhere closer to it.
Right. You don't have to.
I mean, that's what fund managers do, right?
Yes, but I am not.
Okay, that's what
I'm underweight. In fact,
You're
shockingly,
underweight
there's
financials.
consensus bullishness on banks. We have banks, but they're more commercial facing.
Yeah.
They're more commercial facing, so we feel that is where the move is. So even if the banking moves with a lower weightage, we will get a bang for a buck because we feel that we are in the lighter space. We actually favor industrials, commercials, hardcore infra, capital goods, very different from themes and sectors that dominated the last decade.
So how do you decide the weightage then? I mean,
So as I said, our largest weightage is electrical equipments.
how much is that?
We have about 15-16% there. We have about
15-16%.
But
Yeah.
Atul, that's not an index mover, right?
In fact, as a portfolio manager, my job is not to hug the index. If I hug the index, I am not adding value. Then a person may as well go into a passive fund, an ETF. My presence or my value is only if I can create disassociated outsized returns. And that would come by not hugging the index. So we really do not try to hug the index. And that is why you will have sector bets like, as I said, electrical equipments. I think engineering is another very interesting space. Defense is another interesting space. These are sectors and themes which may not have weightages in the index, but we feel that these are stocks and sectors making new highs. And that is what will create the alpha going ahead, and that is where leadership is. So that's why I've been emphasizing that not much is happening on the index. If you're an index hugger, there's not what happening. Yeah. I mean, if a Reliance goes up, Infosys comes down. Yeah. If a L&T goes up and ITC goes up, something else is going down. So net, you're setting off. But in that also, there are a lot of opportunities. Sectors and stocks are doing well. And as and when we come out of this grip, you will find that leadership will come here. And as I said, that ultimately they have been decadal underperformers. They are under-owned.
Now also you feel like
I feel so. I feel that if you look at weightages per se, people have not even got to at par levels. And that, from moving underweight to overweight, when the trend or when the movement happens there, is I think a great opportunity and will give a lot of momentum to these spaces or these sectors.
So if you have to, let's say, talk about the strength in some of these stocks.
Right.
Do you expect them after a decadal underperformance to be an outperformer for at least 3 to 5 years? And we are at the beginning of a multi-year or a multi-quarter outperformance in cap goods, engineering and electrical stocks.
I think so. Because, we saw that last year. Yeah. Right? Look at PSU banks. I mean, last year the index was flat, 3% positive. The PSU index went up 70%.
Yeah. 30%.
So what really happens is that sectors that have underperformed for so long, people naturally get underweight. And sectors which have done well, people are already overweight. So the shift that happens or the sector rotation that happens actually is a very big trigger. So I think if you get your themes right, if you're thematically correct, 70% of your work gets done. 30% is about picking the stock, but 70%, it's like a boat, you know. If the tailwinds are there, your sales are up, it will take you. You may have the best sail and the best boat, but if the tailwinds are not there, the boat doesn't move. So I feel that getting these themes are important, and when themes change, they become very big opportunities. And I think
Okay, that's the take coming in from Atul Suri. He's saying, play with the trend, don't get obsessed with the index. That's in consolidation mode, and that is a good thing. But another big event, this time around, not in Mumbai, but New Delhi, and after Mumbai, actually. It's Delhi saying hello to Apple. Hordes of people once again have lined up at the malls to wait for Tim Cook opening the store, which they did earlier today at 10 a.m. And some loyalists who had already visited the Mumbai launch as well flew all the way back to Delhi too to catch a glimpse of him. Sumita is waiting by to get us all the highlights from how hectic the day has been.
Scenes of exhilaration, jubilation, celebration here at Delhi's Select City Walk Mall in Saket, where Tim Cook, Apple's chief executive officer, came and opened their second official retail store here in India. This, of course, is the mega store that Tim Cook came to inaugurate. He, of course, in proper Apple tradition, he took a couple of customers, initial few customers, to give them a glimpse of Apple, welcome them into the store. And it's not every day that you see Tim Cook here in India. The last time that he came in India was in 2016. After that, a mega push to Apple's retail strategy. Now, once again, Tim Cook came here in India, and of course the mood is celebratory. As you can see all across me, people are sampling Apple products, thinking of what to purchase next, inquiring about products and figuring out all the features of this Apple store, which Apple claims is extremely sustainable and is committed to Apple's commitment to carbon neutrality. So I'm going to be taking you through some of these products yet again. So you have iPads lined up here, Apple Watches, a whole set of products listed here, some Apple phone covers over there, again watch covers, chargers, you name it, and they have it right here.
About Apple, and we have seen that urban consumption is one thing that has been working quite well as far as stock markets is concerned as well, whether it's an Ethos, a Landmark, even Titan for that matter. All of these stocks have been surging, and of course you also have Akshaya Tritiya coming this Saturday, and ahead of that these jewelry companies etc. are doing quite well. So let's pull up the Titan and see what it's up to, and maybe a Kalyan Jewelers as well, because these are the counters which have been holding up comfortably in the green. But Mahantesh, your sense as far as urban consumption is concerned, do you think valuations still allow any fresh buys into these names?
See, urban consumption has been a worry, and that's primarily due to the COVID after effects and inflation being typically very high. Now that we have seen that the RBI announcing a pause, whether it is temporary or permanent is another debate, but the pause definitely tells you that somewhere the inflation is likely to be under control and likely to slide down. This should help revive urban consumption growth in the years to follow. But immediately this current year, the consumption trends on the urban side are pretty weak. Look at two-wheeler, car sales. They're not growing 14-15% year on year on a CAGR basis. You know, we are just about barely growing in single digits. So my worry is that unless we see a proper slide in the inflation, urban consumption demand growth is going to be quite tepid. Moreover, the urban consumption growth also is a function of how housing stock or how real estate growth is. We have had a break in the real estate growth story for a few years, and until that revives, the urban consumption growth will follow a bit later.
Adani Power, they've signed a power supply pact with MPSEZ Utilities. That's the word coming in. Stock holding up by about almost 5% or so. Sudip, it seems that the entire Adani saga is well behind us, right? Or is the market still nervous about what's going to come out next?
Well, some amount of nervousness is definitely, unfortunately, there. I think, after what happened happened, investors are a bit wary. There is an inquiry happening which is mandated by the Supreme Court. SEBI is doing the investigation, and hopefully things will be clarified once for all once this inquiry is over. But at this stage, I think it's to comment on what's going to happen as far as or whether it's over or not is difficult. But I'll maintain what I've been maintaining always. There are some companies of the Adani group which are fantastic companies per se, whether it's in Adani Port, Adani Wilmar, or even Adani Power for that matter. I think they have strong assets on ground, and there is absolutely nothing which a long-term investor should worry about these companies. Of course, it's a matter of what valuation you are entering, and that one has to always watch when you are a stock market investor. But otherwise, fundamentally, these are very, very strong companies. And I will talk about the cement companies also. We've started calling them Adani companies now, but they are strong companies in their own right, Gujarat Ambuja and ACC. There's absolutely no problem. They may be having a quarterly performance problem, a demand challenge, or a pricing pressure, or a pricing power loss, but those are inherent with the business. They have got nothing to do with Adani or Hindenburg. One should look at these companies on a standalone basis, look at the valuation, and decide on taking a position or not. Now, this has got nothing to do with Adani and Hindenburg.
Okay, so that's about some of the cement names as well as the Adani group of companies as well. But Sudip, also your take regarding the mid and the small size banks, because today you have a CSB Bank up 4%, City Union Bank is doing quite well, and off late we have seen quite a bit of traction in some of these names. Is there anything that is catching your attention?
Been positive on the entire BFSI, and I think there are significant opportunities and significant valuation pickup opportunity in the mid-sized banks and some of the mid-sized NBFCs as well. So yes, some of these mid-sized banks you mentioned do look good. Catholic Syrian Bank, definitely a whole lot of things are happening. There is some excitement there. City Union Bank, there was some negative news flow in the past quarter. Things were the bank prices were beaten down, but it's a fundamentally strong bank. They're doing a lot of right things. Federal Bank, I will mention, it's much bigger compared to the ones I talked about, but it's also an excellent bank and they're doing pretty well. There is management stability with Mr. Srinivasan getting extension from RBI. So yes, there are a whole lot of these banks which are doing well and should do well. Credit demand is strong. All of them are very focused on the liability side of the book, and they are trying to bring down the cost of liabilities, which is the right thing to do. Asset quality, of course, has improved significantly and will improve even further.
Right, okay, let's get in some BTST trades as well going before we wind down for the day. Kunal, on your list?
Motherson Sumi is something which I would suggest as a buy. 75, 76 as a target. Stop loss could be kept at 66 mark. And City Union Bank, a stock which has given a breakout today about that 130 plus levels. So would suggest that as a buy. 138 could be a BTST target. Stop loss at 130.
Oh, yes, City Union Bank going pretty strong. Samvardhana, Motherson as well, holding out well. Nuresh, what is your BTST list looking like?
So first is a buy on IDFC Limited. The stock is on verge of a fresh breakout on a 52-week high. Stop loss at 80 and a target price of 85. Second is a bounce back trade on NTPC, which has corrected 10 rupees from the recent highs. Seen a reversal candle today. A stop loss at 168 and a target price of 174.
Okay, so those are some of the counters which are there on the BTST list as well. But for now, it's a day of the weekly options expiry, so maybe a bit of a perk up is what we're seeing in the last 15 minutes, but pretty much flat at the index level, 17,627. Kunal, what's your take as to what would take the markets higher? Because again, it seems like we've hit a bit of rough patch into the consolidation mode.
Yeah, so I think, maybe a couple of days of more consolidation. I don't expect the index to move up in a hurry. I think the good part about the markets is that the open interest is still slowly and gradually building up. So traders are not in a hurry to try and build up positions sizes just because the Nifty is corrected some 200 to 50 odd points from the 3-day, 4-day swing high for itself. So that again gives an indication that maybe traders are waiting out for some more results to come by and some more price action to probably impact the indices. That I believe could be a healthy sign, because when you're looking out for more dips on the indices, and specifically when the index is above those support levels, those support points actually become a good zone where traders can look to initiate a buy. So 17,500 remains to be a key support on the index, and I would believe that till the time we trade above those levels, any dip closer to that point should be taken as a buying.
NCC, Bajaj Auto, ITC. Naresh, will you still be a buyer in all of these three names sitting at 52-week highs?
So NCC continues to be a strong one, still be a buyer on dips out here. Bajaj Auto is actually a fresh breakout, so the stock is now back to the same prices where it was almost in 2021. So it's actually setting up for a longer term breakout. The high was around 4300, 4350 back in 2021 a couple of times. So maybe a little bit of a pause here, but structurally it's a long term breakout of 2 years. So it looks very interesting. ITC is the place where I would not be a buyer. It seems a little overdone in the near term. The risk reward is not great. The stock has doubled up from the zone of 200 to 20, where it was a problem area where it just stayed for a long time. The view is around 420. We would see some bit of a pause on ITC. So not a gung-ho on ITC, but Bajaj Auto on dips as well as NCC.
Right. Okay, those are some stock ideas coming your way from Naresh. Let's revisit some of the other buzzers. Let's see what Tata Com, for instance, is closing in at. They said pretty categorically that they don't see a slowdown in growth momentum and that large deals are coming through unlike earlier. So that's what the market is like, and the stock is going home with a 3% gain. Similar was the commentary from Mastic as well. The order booking, they said, is only expected to go up from here. Paytm as well is the other stock that we've highlighted. Their EBITDA is going to break even by FY25 according to Motilal Oswal estimates, and they've initiated coverage on the stock with a buy rating. Paytm holding up almost 2% as we speak right now. And then Concor as well, which we highlighted earlier, wherein Goldman Sachs has upgraded to a buy from the earlier neutral, and the price target has been upped from the earlier 670 to now 720. That's the other stock which is in focus right now. Sudip, just very quickly, if you could give us your call on a Paytm and Zomato.
I will ask investors to stay away. Just they have improved a little bit or the losses have come down doesn't mean we should start going and chasing these stocks. There is still a long way. Paytm still has to get their business model right. We still don't know what's going to be their revenue driver going forward and what's going to really make the company stand out in the league of big companies or profitable companies. As far as Zomato is concerned, there are many moving parts. They are still a long way from profitability. Blinkit has probably a temporary problem, but it's a problem nonetheless. So I don't think I will recommend investments in either of these two at current levels.
Okay, Sudip, Mahantesh, great to have both of you on the show. We'll let you go on that note. Thanks for taking the time out as always.